Hey, good day, everyone. Bert Salazar here. Welcome to our tax planning webinar. We're going to get started in about 2 minutes. We have a number of people that are logging in. So since I just started broadcasting, more and more people are going to be joining us. So I'm excited to be here with all of you. Obviously, Florida sustained a major hurricane up in the panhandles yesterday. It didn't have any damage. It didn't give us any rain here in South Florida, but obviously we're very concerned about the people up in North Florida, and then obviously Georgia and the Carolinas and so forth. So, you know, again, it's something that we have to deal with on a regular basis here in Florida, but nevertheless, it's not something that we wish to anyone. Today, I'm very excited to be here with all of you, and we're going to get started again, as I just said, in about 2 to 3 minutes. We're actually getting more and more people that are joining us. So today, we're going to be talking about tax planning. I hope all of you are excited about that. You know, one of the things that I say when we do seminars is that, you know, what does tax planning and colonoscopy have in common? And what those two things and those two have in common is that nobody wants it, but everybody needs it. So again, I'm going to try to make it as fun as I possibly can. Whenever we do these tax planning seminars, we normally take anywhere between an hour to an hour and a half. And we do cover a lot of information when we're actually doing physical seminars. When we start to do webinars, as we've been doing for the last year or so, you know, some of the webinars that we do regarding tax planning go longer. They may go to 60 minutes, some of them 90 minutes. This one for tonight is going to be a short one. So this is going to give you an overview of tax planning, and then I'm going to share some things with you that are going to be very critical for you and your family as you start thinking about tax planning for 2018 and beyond. This one is going to be more than likely 30 minutes. So again, I'm going to be impacting you with a lot of information that I think you will appreciate. And then obviously at the very end, if you want to reach out with any specific questions that you will have, then you're going to have the ability to do so, but that would be on your side of the ledger, not ours. So let me see, we have more and more people joining us. So again, those of you that are joining us, again, welcome to our tax planning webinar. We do these just about every other week. As part of the business that we conduct and the education that we conduct, we do podcast. So you have the ability to join our podcast. I do a podcast every single week on a financial topic. We also do actual physical seminars, and then we do webinars every 2 weeks. We also do a lot of campaigns because we feel very strongly that the more education that we can provide to all our clients, the better off our clients are going to be. And at the end of the day, information without education always leads to failure. So the more education we can provide you, the better your financial decision is going to be moving forward into the future. All right, so let me go ahead and share my screen so you can start to see my presentation, and then we'll get started with this webinar. So let me start looking for the area of the webinar and the PowerPoint that I'm going to be sharing with you, and here it is. So you should be able to see it now. And again, welcome everyone. This is going to be a short webinar, but it's going to be full of very good, strong, viable information that all of you can take with you. My name is Bert Salazar with Cambridge, and we do own 3 companies. We own Cambridge, we own Camelot, and then we own Gables Tax Planning Group. Because we as a firm do tax planning, we do insurance, and we do alternative investments. Now, most important, I am a member, and we are a member of SOFA. SOFA is the Society for Financial Awareness, which is a 501c3 nonprofit organization. And the #1 goal for SOFA, and this is why I am in front of all of you tonight, is to provide financial literacy to everyone in the United States and throughout the world. Now, we do have clients that are joining us from Australia, Southeast Asia, South America, Europe. We have clients from all over the world that join us on a regular basis for our webinars because, you know, we do have a lot of clients that are American citizens. They live abroad, and obviously they have to be aware of what's going on from a taxable standpoint in the U.S. We also have international clients that are making investments in the United States, and they want to understand, you know, how to navigate all the different issues and concerns when it comes to tax planning here in the United States and abroad. So again, we're very proud of our affiliation with SOFA because our #1 goal is to provide financial literacy, and we do this through many companies that bring us in throughout the United States, and I'm talking about major corporations that bring us in to educate their executives and to educate their employees in all areas of financial services and so forth. Again, I want to thank you all for joining us today. So hopefully you're going to have a good time with us and with me. I'm going to try to make things brief, but I also want to be brilliant, which is very important for the topics that we're going to be discussing today. And I'm excited, again, once again, to be here with you. Now, we in our firm have a business motto. The business motto for us is, you know, we're changing the world, the financial world, one client at a time. And that's very important for us. You know, our #1 goal through education is to changing lives, you know, one client at a time. And if we can make an impact, a positive impact on your financial world, whether you decide to do business with us or not in the future, we obviously are very happy to be able to do that. Now, we're going to get into tax planning, and you know, you always hear that there are two things that are certain in life, and that's death and taxes. And that's very important to understand because obviously there are things that we can do in order to prolong death. You know, we can exercise, we can eat well, we can work out on a regular basis, we can live an active life. And there are also things that we can do from a taxable perspective to make it better for all of us. At the end of the day, the vast majority of the clients that we engage prior to engaging us for the first time, we find many a times when we do tax audits for them that they're paying more taxes to the U.S. government than they need to. And obviously those are things that are very critical because if I can save you money in taxes, if I can give you ideas that will allow you to minimize your tax liability, it doesn't take any financial risk. And therefore, you're actually putting more and more money into your pocket in order to be able to do that. Now, there are three ways and there are three things that you can do in order to reduce your tax liability. #1, you can report less income. So the lesser income that you report, the better off you would be from a taxable liability. #2, you can increase your deductions, and we'll talk about that in a little bit, because one of the things that we find is that nowadays under the new tax law, there are going to be some benefits that you need to adhere to in order to maximize the opportunity. And the third thing that you have the ability to do is obviously to maximize all the credits that the IRS has the ability to give you if you qualify for that. Now, always remember that although that seems pretty easy and intuitively, one of the things that you need to understand is that the IRS code has over 73,000 pages. Yes, you heard me right, 73,000 pages. So life can get quite complicated along those lines. Now, if you're married, you're filing jointly, you have 3 children, you have one of your children happens to be in college, you own some real estate, you know, your tax liability may be quite complicated. Now, if you happen to be single living at home, obviously it can become quite easy for you to be able to do your taxes. Now, one of the discussions we always have with every single one of our clients that we engage, and many of you that join us on these webinars that we do regularly, is that there is a major difference between tax preparation and tax planning. See, tax preparation occurs usually between January and April. And there, what you're doing is you're going through the process of filing your taxes. You're gathering all your deductions. You're taking a look if you maintain a bookkeeping account. You need to go through your bookkeeping. You're going to need to take all of your W-2s, your 1099s, and then you're going to send that information to your accountant or your tax preparer, and then he or she is going to determine whether you overpaid your taxes, you underpaid your taxes, or if you broke even. That's all about tax preparation. Tax planning is a different and totally different ballgame. Tax planning, it's about taking an active process throughout your entire year and for many, many years to come in order to reduce your tax liability. When it comes to January through April, you're paying the taxes at that point in time. There's no tax planning that you can do between January to April. You need to do that in the previous year, and obviously that's very important because you have to take a long-term strategy. You got to take a look at your overall goals and objectives, and obviously those are things that are very critical, and that is a major difference. Now, we in our firm, not only do we have the ability to do tax preparation for our clients, but most important, we spend quite a bit of time doing tax planning as well. Now, obviously, we need to talk a little bit about your adjustable gross income. An adjustable gross income, as you can see there on the screen, is the income that you generate minus your adjustments to income, which may include your deductions and your credits and so forth. Now, every time you go to a bank and you apply for a loan, the bank is always going to be very concerned about your adjustable gross income. Now, the better tax planning that you will do will reduce your adjustable gross income. Now, that could be a good thing, but if you need to apply for a loan, obviously having an adjustable lower income could be detrimental to you unless you have the ability to provide proof that your income is much higher than your adjustable gross income because of certain deductions, exemptions, and credits that you have obtained over the last several years. Now, let's talk a little bit about deductions and exemptions. And by the way, as a point of reference, when it comes to doing your taxes on an annual basis, think of it this way. Your deductions and exemptions reduce your taxable income. Your credits, on the other hand, reduce your tax liability. So what I'm going to do tonight is I'm going to share with you some of the things that you can do on either side of those ledgers in order to maximize your tax benefits today and for many, many years to come. Now, you can do deductions and exemptions. Under the new tax law, one of the major exemptions that went away was your personal exemption. If you filed taxes in 2017, your personal exemptions just for being alive total $4,050. So if you had a husband and wife and they were married filing jointly, then they were able to have an exemption of $8,100 plus your standard deduction. Because of the fact that under the new tax law, the standard deduction have pretty much doubled from a business perspective, those exemptions have gone away. So for instance, if you had to file taxes in 2017 and you were married filing jointly, your standard deduction was approximately $12,700. Now in 2018, it will be $24,000. So there's a big difference between the two from a business perspective. The other thing that the IRS is telling us now is that because of the increases in your standard deduction, less and less Americans, somewhere between 15 and 25% of Americans will be itemizing their deductions. So the vast majority of Americans are going to be taking the standard deduction because right now it's at a fairly high level. So now, unless you're a business owner and you have additional deductions that you must take, there's a very high probability, or you have a very high mortgage, there's a very high probability that you are going to be using the standard deduction. Now, as you can see there on your screen, those are all the different standard deductions that we can take. Now, one of the standard deductions that is not on the screen, which many of my clients take, is when they make contributions to a qualified plan, meaning a 401k, a 403b, a SEP, a deferred compensation program, an IRA. So if you're making $100,000 and you put $10,000 away in your 401k, then your adjustable gross income, not including your standard deduction and any of that, will go from $100,000 to $90,000. So you're actually deferring the taxes. Now, that's a good thing, but it can also be a bad thing. And the reason for that is the following. When you defer your taxes, you're also deferring your tax liabilities. So that means that, and this is an argument that although I am a tax preparer, I do have arguments and discussions with CPAs on a regular basis, because they're ill-informing their clients. They're saying to their clients, look, if you put money on a 401k, you're saving taxes. In reality, you're not saving taxes when you put money in a qualified plan. What you're doing is you're deferring the tax. And when you are deferring the tax, you're also going to be deferring the tax liability. So the major question that all of us need to ask ourselves is, where do we think that taxes are going to be in the future? Are they going to be higher, lower, or are they going to remain the same? Now, I know based on the new tax law for the next 8 years, taxes are going to be at this level, but who knows who's going to be in power in 2026, because everything ends on December 31st of 2025. Also, when you take a look at the debt in this country, when you take a look at the national debt, which now is exceeding $21 trillion, when you take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt is now exceeding $114 trillion, there's a very high probability that tax liability in the future is going to be much, much greater than it is today. So you have to be very careful as you make contributions to your qualified plans to make certain that you do it and you follow certain rules of engagement that we do with our clients on a regular basis. Now, what happens if you happen to be a business owner? Well, if you happen to be a business owner, you can see there on the screen, you have a lot of deductions you can take, which are very, very critical for many of you. One of the challenges that I have with business owners is that the vast majority of them are not truly taking advantage of all the tax benefits that the IRS code is giving us. Now, one of the things that I always like to share with all of you, and I share in seminars, and I share with each and every one of my clients, is that there is a major difference between tax avoidance and tax evasion. See, tax avoidance is legal. If you're using all the tools that the IRS is giving you in order to minimize your tax liability, then obviously you have a duty to yourself and your family to be able to do that. Now, tax evasion, you're going to end up in jail. So we always want to make certain that we can do as much tax avoidance as possible without crossing that threshold that now brings you into tax evasion. So obviously, as a business owner, there's a lot of things that you can do. Now, one of the interesting things that is happening right now, and primarily because of the power of technology, like right now, many of you are listening to me and are watching me, and you may be in different time zones, you may be all throughout the world. Technology is very powerful. So we do have a lot of business owners that now have home businesses. So If you have a business at home that you run out of your home, there are certain business deductions for having a home office that unless you know how to understand those rules of engagement, you can make mistakes, and those could be very costly mistakes because it can cost you a lot of money at some point in time in the future from a business perspective. So it's critical that you understand the rules of engagement when it comes to tax planning. So I encourage all of you to talk to your tax preparers. Obviously, if you have any questions, you can always reach out to me, and I'll be more than happy to answer any of those questions for you. Now, remember I said that deductions and exemptions reduce your taxable income. Tax credits, on the other hand, reduce your tax liability. And there are a number of tax credits that you can take if and only if you qualify for them. Now, there are primarily two basic differences in tax credits. You have what is known as a refundable tax credit, and then you have your non-refundable tax credit. And the difference between the two is very simple. If you have a refundable tax credit, it means that even if the credit exceeds your liability, then the IRS will send you a refund for that amount of credit that exceeded what your liability was. So let's say they have a tax credit for $1,000 and your liability, your tax liability was only $750. Then the IRS will give you a $250 refund. On the other hand, if you have a non-refundable credit, if in the same exercise your tax liability was $750 and your tax credit was $1,000, they will reduce your tax liability by $750, but you will not get or receive that $250 refund. So as you can see there on your screen, you'll have on the left-hand side all the refundable tax credits, and then on the right-hand side you have the non-refundable tax credits as well. So again, these are things that you need to be careful with, and you need to make certain that you talk to your CPAs or your tax professionals along those lines. Now, the next area that we need to have a quick discussion on will be the area of tax withholding. And this is one of the major areas that we deal with whenever we engage clients when it comes to tax planning. We want to review at least their last 2 years of tax returns. And the reason for that is simple. Remember, our tax system is a pay-as-you-go system. Now, it wasn't always this way, but it became a pay-as-you-go system many, many years ago. And what that means is that if you happen to work for an employer, once you file your W-4, your employer is going to withhold taxes based on your W-4, and then they're going to send those taxes to the IRS code on a pay period basis. So obviously that's very critical to understand. Now, interesting to note, the average tax refund in the United States, it's $3,000. So what that means is that the vast majority of Americans are actually overpaying their taxes. Now, I know that for some of you, it might make sense, to get a nice check in April and you get a tax refund. But think about it from an economic standpoint. If you receive $3,000 every single year based on a tax refund, basically what you have done is that you have given the IRS a tax-free loan for that entire year. Because when they return those $3,000 to you, they're not paying you an interest on that money. Now, if you owe them, they're going to charge you an interest on the money that you owe them, but it doesn't work that way on the other way around. So think of it this way, $3,000 a year that you get as a tax refund equals $250 extra a month that you could have in your pocket. What can you do with $250? Well, you can pay a number of bills. I mean, you can pay your light bill, you can make a car payment, you can put it into savings. So why would you want to give a tax-free loan to the IRS where you're not going to get anything back from it? Now, I'm pretty analytical. I'm not anal, but I am analytical. So think of it this way. If you're getting a $3,000 tax return or tax refund every year for the next 20 years, that's $60,000 that you're getting back from the IRS because you overpaid them over a 20-year period. Now, if on the other hand, you would have taken those $3,000 every single year and you would have invested that money into an investment account, and let's say that investment account was earning you 5%, over a period of 20 years, your account would have been north of $107,000. So when you deduct $107,000 from the $60,000, which was the actual refund that you received, you pretty much had an opportunity cost or a lost opportunity cost of an additional $47,000 that money, just by being on your side of the ledger for that year and then multiply that 20 years as opposed to being on the IRS side of the ledger, would have earned the $60,000 that you would have put in plus an additional $47,000 of interest. So it makes no financial sense whatsoever to try to get a tax refund. At the very best, your number one goal is to break even. Also, remember in 2018, and we're getting closer to the end of the year now, please go back and review your deductions, because due to the fact that now your standard deduction is higher, if you received a $3,000 refund last year, there may be a high probability that for 2018, your tax refund may actually be higher than $3,000. So again, you would have given the IRS a free loan with no need to do so. And we do a lot of work in that area for a lot of our clients. Now, filing status, most of us are pretty aware with that. You can file single, you can file married, filing jointly. You can file married, filing separate. There may be reasons why it might make more sense to be, if you happen to be married, to file separately than to file jointly. And liabilities have a lot to do with that. If you happen to be single, but you're a single parent and you have a child, then obviously instead of filing single, you would want to file as head of household. Because you get higher deductions that you can take in order to reduce your tax liability from a business perspective. And then last but not least, happens to be if you're a qualifying widower with a dependent child as well. So again, you have to be careful how it is so you're going to file your taxes. And by the way, your filing status is determined as of the end of the year, as of December 31st. So you could have been single for 10 months out of the year, then you get married. Now you have the ability to file married filing jointly and get the higher standard deduction along those lines. So those are things that are very critical to understand. Now that we've covered some of the basics when it comes to the IRS and filing statuses and how do deductions, exemptions, and credits come into play, let's talk a little bit about your financial goals. Now, at the end of the day, your financial goals is to maximize your earnings. You may also want to open a business if that's a goal. You want to expedite your retirement planning. In other words, if you happen to be 45 years of age, you may not want to wait to retire until age 65. You may want to fast forward that to age 60 or age 65. There are a lot of things that you may want to do. You may want to put more money and more money away into retirement. And by the same token, maybe you're an employee and you want to become self-employed. So everyone has all types of different financial goals and objectives. But at the end of the day, it's important that you use your tax liability and you use the IRS code as a friend, not as a foe. So you want to make certain that you can maximize all the benefits that the IRS code can give you in order for you to enhance your financial benefits in the future. Now, the type of work that we do for our clients, we do a lot of tax forwarding planning, which is a type of software program that not only does it allow us to minimize the tax liability that our clients are having today, but also how to minimize that tax liability in the future. You know, traditional tax preparation is always looking in the rearview mirror. We look in the rearview mirror to make certain that we can maximize your benefits, but we also look through the front windshield as we're driving down the road of retirement and planning to make certain that we can reduce the tax liability in the future. Now, with that comes something very important. And for those of you that may not know this, there are three major financial buckets in your life. You have your taxable bucket, you have your tax deferred bucket, and then you have your tax preferred bucket. Now, your taxable bucket is you know, traditionally your savings accounts, your money market accounts, your traditional mutual funds, your CDs. The money that you put into that taxable bucket is after tax. And then every year you're going to receive a 1099, which you're going to have to report on your taxes and then pay taxes on that growth in those accounts. Now, from a taxable perspective, the taxable bucket is not the very best bucket to have. On the other hand, it's a bucket that gives you a tremendous amount of liquidity. So we always want to make certain that our clients have at least, you know, 6 months of expenses covered in that taxable bucket that can be used for emergencies, could be used for, you know, business opportunities, etc. The second bucket is the tax deferred bucket. Now, the vast majority of my clients have a better understanding. Let me just drink a little bit of water. They have a much better understanding of what tax deferred bucket is, because that is a savings bucket. That is your retirement bucket. That's a bucket that contain your 401ks. They contain your IRAs. They contain your SEPs. They contain your pension. In that bucket, that money that you put in is pre-tax. So you're actually taking a tax deduction in the year that you make that contribution. The money grows tax deferred. But then when you pull the money out, not only do you have to pay taxes on the contributions, but you're also going to have to pay taxes on the growth of that money in retirement for the rest of your life. So that's a bucket that you need to be very careful. You don't want to have a tremendous amount of assets in that bucket, because when you pull money out of that bucket, you may be actually creating other issues and concerns and other taxable liabilities under what is known as provisional income calculations, where if you take too much money out of your 401ks and your IRAs in retirements, not only would that increase your tax liability on that particular tax deferred bucket, but it also may increase your tax liability on your capital gains distributions, and most important, on your Social Security benefits. Yes. Now, most people don't think that they're going to pay taxes on that Social Security benefit. And the answer is that there's a very high probability that unless you do proper planning, up to 85% of your Social Security benefits are going to be taxable in retirement. Now, if you do proper planning, then you can take that Social Security benefit totally tax-free. Another issue to be worried about in that tax deferred bucket is that the more reportable income that you have, and the more income, especially if you're married filing jointly and you have done fairly well in your financial life, that also may increase your Medicare premium liability at time of retirement. So the taxable bucket and the tax deferred bucket are areas that we do a lot of work with our clients, because we want to help them enhance their contribution to those buckets, but by the same token, we don't want them to increase their tax liability at time of retirement. Now, the last bucket is the tax preferred bucket. That is the least understood bucket under the IRS code. I would argue that 99% of all the clients that we engage for the first time have not taken advantage of the tax deferred bucket. In the tax deferred bucket, the money that you put in is after tax, just like in your taxable bucket. The money grows now tax deferred, just like in your tax deferred bucket. But then when you pull the money out, the money comes out tax free or tax preferred. Now, there are 4 vehicles under the IRS code that meet the specifications to be in the tax preferred bucket. You have your municipal bond funds. You have your Roth IRAs. You have your Roth 401ks. And you have your 7702 plans, which are your cash value life insurance plans. In the next couple of weeks, I'm going to be doing a webinar on the importance of life insurance in a retirement plan because life insurance or 7702 plans have the most amount of tax benefits of any other product under the IRS code. And the vast majority of clients that we engage and the vast majority of you that we engage through our educational process have no clue as to how to maximize those benefits from a business perspective. Now, out of the 4 that I just mentioned in the tax preferred bucket, the municipal bond funds, the Roth IRAs, the Roth 401ks, and the 7702 plans, there are only 3 of them that do not have a negative impact on your provisional income calculations and on your Social Security benefits. Those are the Roth IRAs, the Roth 401ks, and last but not least, your 7702 plans. Municipal bond funds, although you do receive the income free from federal income taxes, the amount of income that you generate from municipal bond funds does get added on to your provisional income calculation to determine what percentage, if any, of your Social Security benefits will be taxable. So from a business perspective, municipal bond funds are not truly, totally tax exempt. Again, when we do our seminars and we do the longer webinars, we go into more details and we actually show you examples on how we have the ability to reduce your tax liability in retirement significantly, where you can maximize your income and pay 0 in federal income taxes to the IRS and be able to divorce the IRS in retirement and be able to do so legally. Now, how wonderful would that be if you have the ability to legally divorce the IRS in retirement? You wouldn't have to take any type of financial risk, because if you don't have to pay, 15, 20, 25, 30, 35% in taxes to the IRS, that's additional income that is coming in into your pocket and out of your family. So obviously, what are some of the tax planning considerations? Well, we've talked about some of those. Keeping your taxes, on the forefront of your mind on a regular basis gives you the ability to start figuring out all your expenditures. If you have a home business, and you're driving to and from work and you have a home office, you obviously want to keep track. And I always recommend that my clients, keep track of their mileages. In the old days, you had to write down your mileages and so forth. Now you can still do that today, but now you have applications so you can download from the internet on your iPhone or your smartphone that give you the ability to keep track of your mileage on a regular basis, so you can take a deduction at the end of the year. So there are a lot of things from a tax planning perspective that all of you should be considering from a business standpoint. Now, what are some of the common tax filing errors? And obviously, because we do tax preparation in our firm, we get these from the IRS on a constant basis, and they're pretty simple. But believe me, millions and millions of Americans are making these mistakes on a regular basis. You know, failure to include your Social Security number, that can delay, you know, your tax refund if you have one. Now, in a perfect world, you wouldn't want to have one, but at the end of the day, the world is not perfect. Failing to document your income. You know, one of the things that you want to try to avoid at audits, you know, audits is just it's just something you don't want to deal with because, you know, obviously they're not pretty, and you know, those you don't want to get invited to that party because they don't serve any alcohol or drink. So, you know, if I'm going to get invited to a party, I want to make certain that it's the type of party that I can enjoy with my wife and my bride, you know, without having to worry about anything else. Mathematical errors, you know, many of you want to do your, you know, if you're doing your taxes yourself, you want to do them by hand. You have to be very careful. Now, there's software available today that you can use, but by the same token, you know, if you're single and you live at home with mom and dad, perhaps it makes sense for you to do your own taxes. But once you start getting into more complicated issues and concerns, then obviously you want to have a tax professional that can do that on your behalf. Claiming too many or too little deductions. Obviously that, you know, if you claim too many, then you're going to owe money to the IRS, and you may have to, you know, depending on where you make your payments, you may have to actually pay interest on that amount that you owe. Or if you're getting a tax refund, then obviously that's not a good thing either. A failure to sign your return can actually delay, you know, your tax refund, if any, and then obviously if you fail to include payment as something that it's not a good thing to do. So again, we're now at the very end of this. With this, I want to go ahead and close this webinar. Is, you know, if you want to, obviously, it's always a good idea. All the information that I've given you today, it's information that you should go back and talk to your tax advisor. If you don't have one, or if you don't feel comfortable with your tax advisor, and you would want to engage us, and obviously you have the ability to do that, because at the end of the day, we're an independent firm. We are not married to any one company. We're not married to any one system or anything along those lines. We are married to our clients, and if you become one of our clients, and you know, that's a win-win, because then we'll have the ability to do tax planning, to do insurance planning, and to do investments and retirement planning as an overall financial blueprint, which is something that we do for each and every one of our clients. So if you're interested in engaging us in a customized tax-preferred retirement blueprint, then obviously you have the ability to do so. Now, if you want to learn more about our capabilities, and you want to learn more about what we may, you know, be able to do for you, sometimes it's not the right fit, and you know, we'll tell you, or you can tell us. Other times, many times it is the right fit. Then feel free to schedule a 30-minute video conference with me or with anyone in our firm, primarily because of the fact that I'm the one coming to you and doing this webinar. You would be scheduling that 30-minute video conference with me, or we can do a simple conference call. And if you want to discuss any specific issues or concerns, then you would have the ability to do so. But at the end of the day, if you want to do that, by the way, there's no cost or obligation for us to have a conversation. Feel free to contact me. And you can reach me at area code 786 766-1092, obviously 1042, 786-766-1042. Obviously, if you're outside the United States, make sure you dial 1 in the country code, and then 786-766-1042. By the same token, if you want to ship me a quick email, you can reach me at Bert, B-E-R-T, .Salazar, S-A-L-A-Z-A-R, at Cambridge, F as in Frank, P as in Paul, LLC.com, or you can reach me to my other email address, which is a simpler one, which is Bert, B-E-R-T, at bertsalazar.com. So let me go ahead and stop the showing my screen. And again, I wanna thank you all for giving me a few minutes of your time. Hopefully the information that I have shared with you has been good information that has made you think, because at the end of the day, information without education leads to failure. And what I always say at the end of every single seminar and every single webinar is my number one goal, and that of my firm, is to kind of change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, thank you so much for giving me a few minutes of your time today, and I look forward to seeing you and talking to you very soon. Take care.